Hi, everyone. Thanks for joining us today. Mark Yestrau here with Bridgeport Asset Management and President here, John Fisher. We just want to take a few minutes today to address and talk about what everybody is talking about right now, and that's all the uncertainty in the markets right now with what's probably going to be the word of the year, tariffs. If there's one thing that the market certainly does not like, it's uncertainty. And with conflicting information being released almost on a daily basis, it's really thrown the market into flux. So we want to talk a little bit today about what we're recommending to our clients they do during these times, and perhaps more importantly, what we did prior to this in terms of building portfolios, because we all know that inevitably there are going to be things to come to roil the markets. Nobody knows when and nobody knows to what degree, but that's really the crux of today's conversation. So one of the terms that's been getting thrown around a lot recently is this term defensive investing. And John, maybe you can speak a little bit to how Bridgeport goes into this in preparation for these type of events.
Sure. I think it's important to say out of the gate that while it's always hard to predict what type of sort of macroeconomic events are going to occur, inevitably something occurs. We wouldn't have really predicted that there would have been a pandemic 5 years ago. If you'd asked us 5 years ago, would there be a trade war going on with our closest trading partner in the U.S. and that we'd be talking about tariffs, I don't think you would have found a lot of people out there who would have predicted that. So I'd say the first thing is it's hard to predict what is going to happen. I think everyone knows that intuitively, but it's pretty easy to kind of predict that there will be those big events. We've seen them, over the decades that both Mark and I have been in the business. There's always something. So it's important that you have a properly positioned portfolio before these events occur, even though they're very hard to kind of predict what they are and how they'll impact portfolios. You want to be properly positioned. So what do I mean by that? I mean, you need to be properly diversified and you need to own high quality assets. So on the first point, proper diversification is key because, as I said, you don't really know what the event's going to be necessarily. You can try to predict, but I don't think you want to invest your portfolio on that basis. So when you're properly diversified, and that means across different types of asset classes, as well as within each of those asset classes, you're spreading out your risk as to how that event will impact your portfolio. If you're too concentrated in any one asset class, or you're too concentrated within a subsegment within that asset class, whether it's a specific industry or a specific geography, that's when you often get caught off guard when these big events happen, and you take a unusually large loss that can be difficult to really recover from. So it's really important to have proper diversification and to own a high quality cash flow producing assets so that when these events occur, and they all take us by surprise to some extent, you are properly positioned and that you're able to weather the storm.
Yeah, and so I couldn't agree more. And of course, we talk about diversification among industries and asset classes, and maybe we should talk a little bit about the public and private worlds as well,
Sure.
Which really, in the private asset class, they're really sort of designed to weather these storms in a better way.
Yeah. So as you know, a key part of our strategy here for our clients is to mix publicly traded assets, i.e. stocks and bonds, with privately held assets, which would typically be private equity ownership of private companies, private lending and other income producing strategies, private real estate, as well as infrastructure. And the benefit of really combining the publicly traded and private assets is that you significantly reduce overall portfolio volatility, and you typically reduce portfolio sort of losses in times of stock market volatility. And we've seen this in the past with our portfolios in 2022 and other kind of downturns. And so again, it goes back to that level of diversification where if you can limit losses during bad periods, spread out your risk, it's much easier to stay invested over the long term. It's much easier to be thoughtful about the allocation in your portfolio, which is to publicly traded stocks, which at a given time may not be doing well because you don't have all of your eggs in the stock market basket, so to speak. So if that part of your portfolio is down a little bit more, but you have other parts of the portfolio, whether it's fixed income or some of those private asset categories holding up your portfolio and possibly even generating positive returns during that period, it makes it a lot easier to think like a long-term investor as it relates to the stock market component of your portfolio, which is really one of the key elements to successfully allocating money to the stock market and earning good rates of return over the long term.
Yeah, great segue. In fact, so to the point, we're getting calls from our clients and we're saying, should we be doing anything? Should we be making changes? Should we be going to cash? And you think you just made an excellent point that when the portfolio is as well diversified as it is, with the assurance of the good quality assets in the portfolio, the temptation to go to cash is wildly reduced. But that said, specifically to the point, are we suggesting that clients panic and go into cash and make rash decisions based on conflicting information?
Yeah, I mean it's extremely seductive, this idea when there's volatility, and unfortunately the idea usually comes up after people have already watched the stock market go down, where they're like, why don't we just go to cash? And the idea of taking risk off of the table and quote getting out, it's an understandable temptation. The problem with it is that the stock market specifically, it's so fast moving that often by the time you're thinking about that, there's already some kind of degree of loss that you've already incurred, and it's kind of late in the game. And even if you are able to sort of limit temporary losses by selling out, the problem is you don't know when to get back in. And really, that's a very difficult game to be playing, is really timing the market. I think everyone knows it's very difficult to time the market. It's probably easier to time the exit from the market than it is to time your re-entry into the market. And if you miss that re-entry point, you can miss a significant upswing, so that when you start looking at your long-term rates of return, when you're constantly getting out of the market and trying to get back in at the right time, pretty much every academic study shows that will result in lower long-term rates of return on a portfolio. There's just really very few people, if any, that have been able to successfully do that. I think if we were sitting here with, say, Warren Buffett, or sitting here with Charlie Munger, or the late Charlie Munger, I'm pretty sure they would say, even some of the smartest guys out there managing money, that is not how they would see the market, and it's not what they would recommend for individual investors to do. You really have to stay the course. So what we've chosen to do is, because we're so kind of diversified, we think it really makes it easier to some extent for clients to stay the course, to think long term, because again, they don't have all of their eggs in the stock market basket. They are generating investment returns from all of these other sources. And so, we think that's kind of the key to sort of long-term success in the investment, in the investing world.
Couldn't agree more. Thanks, John. Thanks for your time. For more information, please visit bridgeportasset.com.